Ladies and gentlemen, the world is changing. The financial landscape as we know it is shifting beneath our feet. The old guard, the institutions that have held the reins of power for decades, are waking up. They're realizing that the future isn't in the crumbling structures of traditional finance, it's in crypto. And yet, in the midst of this revolution, there's one asset that's been overlooked, underestimated, even doubted: Ethereum. You see, Ethereum has been underwhelming this cycle. While Bitcoin has soared, while Solana has rallied, Ethereum has lagged behind. The price action? Disappointing. The sentiment? Gloomy. Investors are waiting for a spark, a catalyst, something that will reignite the fire. And if you're one of those investors, I've got good news for you. Because what's happening right now behind closed doors is nothing short of monumental. Institutions, the same ones that called crypto a scam, the same ones that try to suppress this industry, are quietly accumulating Ethereum. And they're not doing it for fun. They're doing it because they see what's coming. They understand that Ethereum isn't just another blockchain, it's the foundation of the next financial revolution. And if you're still sleeping on Ethereum, it's time to wake up, because what's about to happen will go down in history. Ethereum's biggest pump is incoming. And if you're not ready, you're going to miss out on one of the greatest wealth transfers of our time. Now let me ask you something. Have you ever wondered why the wealthiest individuals always seem to be ahead of the curve? Why they make moves before the masses even catch on? It's because they understand one fundamental truth. Money moves in silence. Right now, the biggest players on Wall Street are making their moves. Hedge funds, institutional investors, high net worth individuals. They're all accumulating Ethereum, not because it's a trending topic on social media, but because they see what's happening beneath the surface. They see Ethereum's dominance in decentralized finance, DeFi. They see the tokenization of real-world assets. They see the explosion of layer 2 solutions and the unparalleled security that Ethereum provides. They understand that this is not just another speculative asset. This is infrastructure, the backbone of a decentralized future. And yet the average investor still doesn't get it. They look at Ethereum's price chart and think it's weak. They see the FUD, the uncertainty, and they hesitate. Meanwhile, the smart money is loading up, preparing for the inevitable shift. Do you think BlackRock is interested in Ethereum because it's a nice project? Do you think JP Morgan is exploring Ethereum's potential just for fun? No, they're positioning themselves for the future. And if you're not doing the same, you're going to be left behind. Institutional adoption is accelerating. Ethereum's integration into traditional finance is occurring at an unprecedented pace, marking a fundamental shift in how major financial institutions perceive blockchain technology. Historically, banks, hedge funds, and institutional investors were skeptical of cryptocurrencies, dismissing them as speculative, volatile, and unregulated. However, as the blockchain ecosystem has matured, these same institutions have begun to recognize the immense potential Ethereum holds as an infrastructure layer for the financial world. Major institutions are embracing Ethereum. In recent years, some of the world's largest financial entities, including BlackRock, JP Morgan, Goldman Sachs, and Fidelity, have started exploring and investing in Ethereum-based solutions. BlackRock, the world's largest asset manager, has been actively working on crypto products, including Ethereum-based funds and tokenized security. JP Morgan, once critical of cryptocurrencies, has launched the JPM coin and is actively involved in blockchain-based settlement systems utilizing Ethereum's network. Fidelity, a financial services giant, has introduced Ethereum custody services, allowing institutional investors to safely store and manage ETH holdings. The growing interest from institutions is not merely speculation. These firms are not just investing in Ethereum as a digital asset. They are building infrastructure, launching Ethereum-based funds, developing smart contract applications, and integrating Ethereum-based solutions into their financial products, Ethereum ETFs, and investment products. One of the most significant developments in institutional adoption is the approval and launch of Ethereum-based exchange-traded funds, ETFs. While Bitcoin ETFs have already gained traction, Ethereum ETFs are poised to open the floodgates for mainstream institutional investment. Asset managers are increasingly filing for Ethereum spot ETFs, which would allow investors to gain direct exposure to ETH without holding the asset themselves. The introduction of such financial products provides legitimacy to Ethereum and signals confidence in its long-term potential. Ethereum as the preferred blockchain for tokenization. The tokenization of real-world assets, RWA, is one of the most promising applications of blockchain technology, and Ethereum is at the forefront of this movement. Real estate, government bonds, equities, commodities, fine art, and intellectual property are being digitized and represented as tokens on Ethereum's blockchain. Institutions are leveraging Ethereum's smart contract capabilities to facilitate secure, transparent, and efficient transactions of these tokenized assets. For instance, JP Morgan's Onyx blockchain project is built on Ethereum, enabling the tokenization of assets and facilitating instant settlement between financial institutions. Similarly, the European Investment Bank, EIB, issued a $100 million digital bond on Ethereum, demonstrating how traditional finance is transitioning to blockchain-based solutions. As more institutions tokenize assets on Ethereum, the demand for ETH will inevitably surge, further solidifying its role as the backbone of digital finance. Ethereum's role in decentralized finance, DeFi. Institutional players are also entering the decentralized finance, DeFi space, which is largely built on Ethereum. Unlike traditional banking, DeFi offers permissionless lending, borrowing, staking, and yield farming opportunities without intermediaries. While DeFi initially catered to retail investors and crypto-native firms, institutional capital is now flowing into protocols such as Aave, MakerDAO, and Compound, which provide regulated and institutional-grade DeFi services. Aave's Aave Arc is a prime example of how DeFi is being tailored for institutions. This permission liquidity pool allows verified institutional participants to engage in DeFi lending and borrowing while adhering to regulatory requirements. As DeFi continues to mature, more institutional-grade solutions will emerge, further integrating Ethereum into traditional finance. But Ethereum staking and institutional participation. The transition to Ethereum 2 and the shift to a proof-of-stake POS consensus mechanism have made Ethereum an attractive yield-generating asset for institutional investors. Staking Ethereum allows investors to earn passive income by securing the network, making it an appealing alternative to traditional fixed-income investments. Institutional staking services have emerged to cater to large investors looking to participate in Ethereum's staking economy without the technical complexity of running their own validator nodes. Companies like Coinbase, Binance, and Lido Finance offer institutional-grade staking solutions, enabling hedge funds and asset managers to generate yield on their Ethereum holding. As more ETH is locked in staking contracts, the circulating supply decreases, creating a potential supply shock that could drive Ethereum's price higher. This dynamic incentivizes further institutional investment, as large players seek exposure before Ethereum becomes even scarcer. Regulatory clarity boosting institutional confidence. One of the biggest barriers to institutional adoption of Ethereum has been regulatory uncertainty. However, governments and financial regulators worldwide are gradually providing clearer guidelines for crypto assets, making it easier for institutions to enter the market. For example, the U.S. Securities and Exchange Commission, SEC, is increasingly engaging with crypto firms to establish a regulatory framework for digital assets. The European Union's Markets in Crypto Assets (MiCA) regulation is set to provide a structured legal framework for Ethereum and other cryptocurrencies, paving the way for greater institutional participation. As regulations become more defined, institutions will have greater confidence in integrating Ethereum into their financial operations. Once regulatory concerns are addressed, the influx of institutional capital will accelerate dramatically. Ethereum's competitive advantage over other blockchains. While other blockchain networks like Solana, Avalanche, and Polkadot have emerged as competitors, Ethereum remains the preferred choice for institutions due to its robust security, decentralization, and developer ecosystem. Ethereum has the largest developer community in the blockchain space, continuously improving the network's functionality and security. Unlike centralized alternatives, Ethereum's decentralization ensures that no single entity controls the network, making it a more reliable infrastructure for institutional finance. Moreover, Ethereum's upgrade to Ethereum 2 and the introduction of Layer 2 scaling solutions such as optimistic rollups and ZK proofs are addressing its historical challenges of high transaction fees and slow processing times. These advancements make Ethereum more scalable and efficient, reinforcing its position as the leading blockchain for institutional adoption. Ethereum's base layer, Layer 1, operates on a decentralized proof-of-stake POS consensus mechanism, ensuring security and transparency. However, because every transaction must be validated and recorded on the Ethereum blockchain, the network can handle only a limited number of transactions per second. At peak usage times, Ethereum can become congested, causing gas fees to spike to exorbitant levels. This issue has significantly impacted industries such as decentralized finance, DeFi, non-fungible tokens, NFTs, gaming, and tokenized assets where users need fast and cost-effective transactions. For example, during the 2021 bull run, gas fees for simple ERC20 transfers often exceeded $50 or $100, making Ethereum impractical for microtransactions in small traders. The NFT boom saw minting fees reach hundreds of dollars, making it inaccessible to many users. DeFi applications like Uniswap and Aave faced high transaction fees that discouraged small investors from participating. To solve this, Layer 2 solutions have been developed to offload much of the transaction processing away from Ethereum's base layer while still maintaining security and decentralization. Optimistic rollups, a key Layer 2 scaling solution. How optimistic rollups work. Optimistic rollups process transactions off-chain but submit transaction data to Ethereum in batches, significantly reducing network congestion. They operate under an optimistic assumption, meaning they assume all transactions are valid unless proven otherwise. Here's how they work. Transactions occur off-chain, reducing the load on the Ethereum mainnet. Batches of transactions are periodically posted to Ethereum's base layer. Validators have a challenge period, usually 7 days, where they can submit fraud proofs if they detect invalid transactions. If fraud is detected, the invalid transaction is reverted and the fraudulent party loses their stake as a penalty. This system dramatically reduces the number of on-chain computations, improving Ethereum's scalability without sacrificing security. Benefits of optimistic rollups. Scalability. Can process up to 100x more transactions per second than Ethereum's base layer. Lower gas fees. Transaction costs are dramatically reduced since multiple transactions are batched together before being recorded on Ethereum. Security. Since transactions ultimately settle on Ethereum, they inherit its security guarantees. Popular optimistic rollup solutions. Several major projects are developing and implementing optimistic rollups. Arbitrum. One of the most widely adopted Layer 2 networks, Arbitrum provides lower fees and faster transactions for DeFi applications. Optimism, another leading rollup solution, Optimism reduces gas fees and improves transaction speeds while maintaining Ethereum's decentralization. Many DeFi protocols, including Uniswap, Aave, and Synthetics, have integrated optimistic rollups to provide users with cheaper and faster transactions. Zero knowledge. Proofs, the next generation of Layer 2 scaling. How ZK rollups work. Zero-knowledge rollups take a different approach to scalability by using cryptographic proofs to verify transactions without revealing the details of each transaction. Instead of assuming transactions are valid like optimistic rollups, ZK rollups generate cryptographic proofs that confirm the validity of transactions before posting them on Ethereum. How it works. Transactions are bundled together and executed off-chain. A validity proof, ZK-SNRC or ZK-STARK, is generated to confirm that all transactions are legitimate. This proof is submitted to Ethereum, reducing the amount of data that needs to be processed. Since transactions are verified before submission, there's no need for a dispute period, making them much faster than optimistic rollups. Benefits of ZK rollups. Ultra-fast transactions, because transactions don't need a dispute period, they settle almost instantly. Lower fees. By minimizing the amount of data posted on Ethereum, ZK rollups dramatically cut costs. Stronger privacy. Zero-knowledge proofs allow transactions to be verified without revealing sensitive information. Popular ZK rollup solutions. Several major projects are developing and deploying ZK rollup technology. ZK Sync, developed by Matter Labs. ZK Sync enables fast, low-cost Ethereum transactions with instant finality. StarkNet, developed by Starkware. StarkNet uses ZK Starks to provide scalable solutions for Ethereum applications. Polygon ZK EVM. Polygon has launched its zero-knowledge Ethereum Virtual Machine, SDK, EVM, which allows Ethereum smart contracts to run on a ZK rollup without modification. DeFi platforms and NFT marketplaces are rapidly adopting ZK rollups due to their ability to provide near-instant, low-cost transactions. Ethereum's future with Layer 2 scaling. The rise of Layer 2 solutions is transforming Ethereum into a more scalable and efficient network. As Ethereum continues to dominate the blockchain space, L2 adoption is growing rapidly. Key impacts of Layer 2 on Ethereum's ecosystem. Mass adoption. Lower fees and faster transactions will make Ethereum more accessible to mainstream users and businesses. DeFi growth L2 solutions allow DeFi platforms to scale efficiently, attracting more institutional and retail investors. NFT expansion. Lower transaction costs will make NFT minting and trading cheaper, fostering greater innovation in digital art and collectibles. Gaming and metaverse, blockchain-based gaming and metaverse applications will thrive with instant and low-cost transactions. Enterprise adoption. More companies and financial institutions will be able to integrate Ethereum into their operations. With the continued development of optimistic rollups, ZK rollups, and other L2 solutions, Ethereum is on track to handle millions of transactions per second while maintaining its decentralized and secure nature. The world is undergoing a massive shift in how assets are owned, traded, and managed, and Ethereum is at the forefront of this revolution. The concept of tokenization, the process of converting real-world assets, RWAs, into digital tokens on the blockchain, is poised to transform global finance, real estate, fine art, intellectual property, and even traditional financial instruments like stocks and bonds. The rise of tokenization, a new financial era. Tokenization is not just a trend, it is a paradigm shift that is fundamentally changing the way value is stored and transferred. Institutions, governments, and investors are rapidly recognizing the benefits of digital asset ownership on blockchain networks. And Ethereum is the primary blockchain leading this transformation. As the most secure, decentralized, and widely adopted smart contract platform, Ethereum provides the perfect infrastructure for creating, issuing, and trading tokenized assets. With institutional adoption accelerating, the demand for Ethereum-based tokenization solutions is expected to skyrocket in the coming years. What is tokenization? Tokenization refers to the process of representing real-world assets, RWAs, as digital tokens on a blockchain. These tokens can represent ownership rights, financial value, or access to specific privileges. By converting physical assets into blockchain-based tokens, companies and individuals gain access to a more transparent, efficient, and liquid financial system. Key benefits of tokenization. Fractional ownership allows users to buy and sell fractions of an asset, increasing accessibility to high-value investments. Increased liquidity. Tokenized assets can be traded 24/7 on decentralized markets, removing traditional barriers to liquidity. Lower transaction costs. Blockchain-based transactions are cheaper and more efficient than traditional settlement methods. Transparency and security. Every transaction is recorded on Ethereum's immutable blockchain, reducing fraud and increasing trust. Programmability. Smart contracts automate compliance, dividends, royalties, and asset transfers, streamlining financial operations. The applications of tokenization are vast, and Ethereum's flexibility, security, and scalability make it the ideal platform for these digital transformations. Ethereum's role in tokenizing real-world assets. Ethereum is the undisputed leader in asset tokenization due to its dominance in decentralized finance, DeFi, smart contract reliability, and institutional adoption. Major financial institutions, asset managers, and governments are already experimenting with Ethereum-based tokenization to modernize financial markets. 1. Real estate tokenization. Traditionally, real estate has been an illiquid, expensive, and slow-moving asset class. Buying and selling property involves middlemen, paperwork, high fees, and long settlement times. Tokenization removes these inefficiencies by digitizing real estate ownership and making property investments more accessible. Example, real estate on Ethereum. Companies like Realty and Labs Group are using Ethereum to fractionalize real estate, allowing investors to buy and trade shares of income-generating properties. St. Regis Aspen Resort issued tokenized shares on Ethereum, allowing global investors to own a fraction of the luxury hotel. Real estate developers are exploring Ethereum-based tokenized mortgages and rental agreements, streamlining property management. Impact. Tokenized real estate will enable instant property transfers, eliminate unnecessary intermediaries, and create global real estate markets where anyone can invest with just a few clicks. 2. Tokenizing stocks, bonds, and traditional financial instruments. Traditional finance relies on centralized intermediaries for trading stocks, bonds, and securities. However, Ethereum's smart contracts and decentralized exchanges, DEX, are making it possible to tokenize and trade financial instruments seamlessly. Example, financial markets on Ethereum. JP Morgan and Goldman Sachs are experimenting with Ethereum-based blockchain networks for issuing and trading tokenized bonds. The European Investment Bank, EIB, issued a $100 digital bond on Ethereum, demonstrating how traditional finance is shifting to blockchain. Stock tokenization allows investors to buy fractional shares of companies without going through brokers or stock exchanges. Impact: tokenization of stocks, bonds, and derivatives will eliminate settlement delays, reduce costs, and increase accessibility for global investors. 3. Fine art and collectibles. The art industry has historically been an exclusive and illiquid market dominated by elite collectors and galleries. With Ethereum's NFT technology, fine art is being tokenized and democratized, enabling fractional ownership of high-value artworks and collectibles. Example: fine art tokenization on Ethereum. Beeple's digital artwork sold for $69 via Ethereum's NFT technology, proving the market for tokenized art. Companies like Masterworks allow investors to own fractions of famous paintings, making blue-chip art accessible to a wider audience. Luxury brands and museums are launching blockchain-based authentication systems, ensuring the provenance of rare collectibles and historic artifacts. Impact: tokenized art will make high-value assets more liquid, secure, and globally tradable. 4. Intellectual property and royalties. Musicians, writers, and content creators often struggle with unfair revenue distribution and complicated royalty systems. Ethereum smart contracts enable automated, transparent royalty payments through tokenized intellectual property (IP). Example: music and IP tokenization. Rack, Grammy-winning musician, released an Ethereum-based NFT album, allowing fans to own digital rights to his music. Ethereum smart contracts ensure automatic royalty distribution to content creators, eliminating middlemen. Platforms like Royalty.io allow fans to invest in musician songs, earning a percentage of streaming revenue. Impact: Ethereum-powered tokenization will revolutionize the creator economy, giving artists direct control over their revenue streams. The institutional rush toward Ethereum tokenization. Major financial institutions are actively integrating Ethereum's tokenization capabilities into their business models. Notable developments: BlackRock is exploring Ethereum-based tokenized funds, allowing investors to trade real-world assets on the blockchain. Bank of America and Citibank are researching Ethereum-powered settlement systems for financial markets. Visa and MasterCard are experimenting with tokenized payment solutions to modernize the financial industry. Ethereum is not just a blockchain. It is the foundation of the next financial revolution. As institutions increasingly deploy Ethereum-based tokenized assets, the demand for ETH is rising at an unprecedented rate. This growing adoption, coupled with Ethereum's unique economic model, is creating a supply squeeze, a situation where the available supply of ETH is shrinking while demand continues to increase. With Ethereum's staking mechanism, institutional accumulation, and DeFi integration, ETH's circulating supply is being removed from the open market, setting the stage for a massive supply shock that could drive prices to new heights. Ethereum's shrinking supply: what's causing the squeeze? Unlike Bitcoin, which has a fixed supply of 21 million coins, Ethereum's supply dynamics are adaptive and influenced by network activity. However, recent developments have led to a significant reduction in each circulating supply, creating an environment where scarcity is increasing while demand is accelerating. The three major factors contributing to Ethereum's supply squeeze are Ethereum 2, staking ETH locked-in validators, ETH locked-in DeFi protocols, institutional accumulation. Each of these factors is removing large amounts of ETH from circulation, decreasing the available supply on exchanges, and driving up potential price pressure. 1. Ethereum 2, staking ETH locked-in validators. Ethereum's transition from a proof-of-work to a proof-of-stake consensus mechanism has fundamentally changed its economic model. With Ethereum 2 and staking, investors can now lock up their ETH to secure the network and earn rewards. How ETH staking reduces supply. Staked ETH is locked in validator nodes and cannot be instantly sold on the market. Over 30 million ETH is currently staked, representing over 25% of Ethereum's total supply. The longer ETH remains staked, the less is available for trading, creating a scarcity effect. Impact. Ethereum's staking model is effectively removing a massive portion of ETH from circulation, reducing selling pressure and increasing scarcity. As staking yields remain attractive, more investors and institutions are choosing to lock up ETH for long-term rewards, further tightening the supply. 2. ETH locked in DeFi protocols, a liquidity drain. Ethereum is the backbone of the decentralized finance DeFi ecosystem, hosting major protocols like Aave, MakerDAO, Compound, and Uniswap. These protocols require users to lock up ETH as collateral for lending, borrowing, and yield farming. How DeFi reduces circulating supply. Users deposit ETH into DeFi platforms to earn interest, reducing available ETH on exchanges. Wrapped ETH is used in smart contracts, further locking up liquidity. Stablecoins like DAI issued by MakerDAO, removing it from circulation. Impact. Over $50 billion is currently locked in DeFi, with a significant portion in Ethereum-based protocols. The more Ethereum is integrated into DeFi, the greater the liquidity drain, reducing the supply available for trading. 3. Institutional accumulation. Wall Street is buying Ethereum. Major financial institutions, hedge funds, and corporations are aggressively accumulating ETH, recognizing its potential as the backbone of tokenized assets and the decentralized economy. Why institutions are buying ETH? Ethereum is becoming a preferred asset for investment funds, e.g. BlackRock's Ethereum-based funds. The Ethereum ETFs are on the horizon, further increasing institutional demand. Banks are experimenting with Ethereum for financial settlements, requiring large ETH reserves. Impact. As institutions accumulate Ethereum for long-term holdings, staking, and financial settlements, the available supply on exchanges continues to shrink, exacerbating the supply squeeze effect. Ethereum's burn mechanism, making ETH even more scarce. Ethereum's EIP 1559 upgrade, introduced in 2021, added a burn mechanism that permanently removes ETH from circulation. How EIP 1559 works. Every Ethereum transaction includes a base fee that gets burned, reducing total supply. The more activity on the network, the more ETH is burned, leading to a deflationary effect. During high demand periods, Ethereum's burn rate can surpass new ETH issuance, making ETH ultra scarce. Impact. Unlike traditional fiat currencies which suffer from inflation, Ethereum's burn mechanism ensures that ETH supply can decrease over time, making it more valuable as scarcity increases. The perfect storm, supply shock and price explosion. With Ethereum supply shrinking due to staking, DeFi, institutional accumulation, and burning, the available ETH for trading on exchanges is reaching record lows. What happens in a supply shock? As less ETH is available for purchase, prices increase due to higher demand and lower supply. Retail and institutional investors rush to buy ETH before it becomes even scarcer, further accelerating the price surge. Once a critical supply shortage occurs, even small buy orders can drive ETH prices significantly higher. Historical example. Bitcoin has experienced multiple supply shocks after its halvings, leading to massive bull runs. Ethereum's supply squeeze is creating a similar effect, with some analysts predicting that ETH could surpass its all-time high in the coming years due to scarcity-driven demand. What does this mean for Ethereum's future? Ethereum's supply squeeze is not temporary. It's a long-term structural shift that will continue to impact prices for years to come. Key takeaways. Ethereum's staking model is permanently reducing circulating supply. DeFi is locking up massive amounts of ETH, decreasing liquidity. Institutions are accumulating ETH for the long haul. The EIP 1559 burn mechanism is making ETH deflationary over time. With all these factors combined, Ethereum is set up for a major price appreciation driven by one of the biggest supply shocks in crypto history. One of the biggest hurdles preventing the mass adoption of Ethereum and blockchain technology has been regulatory uncertainty. Governments, financial institutions, and investors have been hesitant to go all in on Ethereum due to the lack of clear legal frameworks. However, this is rapidly changing. Regulatory clarity is not just a compliance issue, it is the final catalyst that will unlock Ethereum's full potential. As global authorities work to create clear, supportive, and balanced regulations, Ethereum is being positioned as the backbone of the future financial system. Once regulatory uncertainty is removed, institutional investment and mainstream adoption will surge like never before. Why regulation has been a barrier to adoption. For years, Ethereum and the broader crypto industry have faced uncertainty regarding how governments classify and regulate digital assets. Key concerns have included legal classification. Is Ethereum a commodity, a security, or a currency? Different regulatory bodies such as the SEC, U.S. Securities and Exchange Commission, and CFTC, Commodity Futures Trading Commission, have debated Ethereum's classification, creating uncertainty for institutional investors. Investor protections. Regulators want to prevent fraud, market manipulation, and illicit activities while ensuring fair access to Ethereum-based financial products. Taxation and compliance. Businesses and investors require clear tax policies on Ethereum transactions, staking rewards, and DeFi profits. Stablecoins and CBDCs. Many governments are exploring central bank digital currencies and stablecoin regulations, impacting how Ethereum-based stablecoins like USDC and DAI function in the economy. Without clear guidelines, many large institutions have stayed on the sidelines, waiting for a defined legal framework before fully committing to Ethereum. The global push for clear Ethereum regulations. 1. The United States institutional recognition of Ethereum. The SEC and CFTC have acknowledged Ethereum's importance, with many experts arguing that ETH should be classified as a commodity, not a security. Ethereum ETFs are under review, and approval could lead to massive institutional inflows. Major financial firms, including BlackRock, Fidelity, and JP Morgan, are lobbying for Ethereum-friendly regulations. 2. The European Union, leading the way with MiCA. The EU's Markets and Crypto Assets (MiCA) framework is one of the most comprehensive regulatory policies in the world, setting guidelines for Ethereum-based assets, DeFi, and stablecoins. MiCA provides legal certainty, allowing financial institutions to integrate Ethereum into mainstream finance. 3. Active adoption of blockchain regulation. Hong Kong, Singapore, and Japan are actively creating Ethereum-friendly regulations, attracting businesses and investors. China's digital yuan, CBDC, may eventually interact with Ethereum-based systems, increasing demand for blockchain interoperability. How regulatory clarity will unleash Ethereum's growth. 1. Institutional adoption will accelerate. With regulations in place, banks, hedge funds, and corporations will fully integrate Ethereum into their financial products. Ethereum-based ETFs, tokenized assets, and smart contract-driven finance will gain mass adoption. 2. DeFi will become a global financial standard. Regulatory clarity will attract more users and institutions to Ethereum-based DeFi platforms. More liquidity, innovation, and security will fuel DeFi's expansion. 3. Tokenization will skyrocket. Governments and businesses will use Ethereum to tokenize assets, real estate, stocks, and intellectual property, making it the foundation of the digital economy. 4. Ethereum's price will benefit from institutional influence. Clear regulations will bring billions of dollars into Ethereum, driving long-term price appreciation and increasing ETH's role in global finance. Conclusion: Ethereum's future is unstoppable. Ethereum is on the verge of a historic transformation. Every major financial shift happening today, from institutional adoption to tokenization, layer 2 scaling, supply shocks, and regulatory clarity, is setting the stage for Ethereum to become the backbone of the global economy. Key takeaways: institutional adoption is accelerating. Wall Street is accumulating Ethereum, launching Ethereum-based funds, and integrating Ethereum into financial markets. The Layer 2 solutions are solving Ethereum scalability issues. Optimistic rollups and ZK rollups are making Ethereum faster, cheaper, and more efficient, ensuring mass adoption. The tokenization is just beginning. Ethereum is leading the tokenization revolution, digitizing real estate, stocks, bonds, fine art, and intellectual property. The supply squeeze is real. With ETH locked in staking, DeFi, and institutional reserves, circulating supply is shrinking, creating a massive supply shock that will drive prices higher. Regulatory clarity will unlock Ethereum's full potential. As governments finalize regulations, Ethereum will gain mainstream legitimacy, attracting billions of dollars in new investment. The road ahead: a new financial era powered by Ethereum. Ethereum is no longer just a cryptocurrency. It is the infrastructure for the next generation of global finance. The combination of scarcity, institutional backing, technological innovation, and regulatory clarity will make Ethereum one of the most valuable assets in the world. Those who understand Ethereum's role in this transformation early will be at the forefront of one of the greatest wealth transfers in history. The floodgates are about to open. The Ethereum revolution is here.